Welcome to The Explainer. Today, we're going to pull back the curtain on the world of venture capital. We're going to get into the real costs that actually drive those high-stakes investment decisions you always hear about.
We hear stuff like this all the time, right? VCs are always hunting for visionary founders and these huge world-changing ideas. It's a really powerful story of ambition and betting on the person, not just the plan.
But you gotta ask, why? Why are they so obsessed with finding the next big thing? Is it just about ego, or is there some kind of fundamental business reality that's forcing their hand? Okay, let's dive into that because the answer really reveals their entire playbook.
So to really understand the venture capitalist mindset, we first have to look at the firm itself. How it actually operates day to day.
And this right here is the first crucial point. A VC firm isn't some abstract bank account. It has partners, associates, and staff. It's got office rent, travel budgets, and a whole bunch of legal bills. It operates just like any other company.
So you might be wondering, where does the money to pay for all that stuff come from? Well, it's not from investment profits, at least not at the beginning. Most VCs charge their own investors an annual management fee, usually around 2% of the total fund. And that 2%, that's what pays the bills. This simple fact is the key to their entire strategy.
All right, so let's look a little closer at what those costs really are. What's all this money being spent on? The sources point to this really critical concept called investment overhead. Now, this isn't the money they put into startups. This is the cost of just running the firm itself, and it's paid for by that management fee we just talked about. It's kind of like the hidden engine that drives the whole decision-making process.
So what exactly makes up this overhead? What are we really talking about here? Let's break it down.
What's really wild is how these costs just pile up. Think about it. From scouting thousands of startups just to find a few promising ones, to paying lawyers and accountants to check out a single deal. Every single one of these steps adds to the firm's costs before they ever see a single dollar of profit.
Okay, so we've got all this overhead, all these costs. How in the world does that connect to their famous strategy of hunting for unicorns? Let's connect the dots.
And this is the core logic right here. Because of these high fixed costs for every single investment they make, VCs just can't afford to invest in companies that are only going to have modest, safe returns. The math it doesn't work for them.
And this slide just lays it all out, doesn't it? You can really see the financial reality they're in. Those small, safe wins, the kind that might make a founder super wealthy, they just don't pay the bills for the VC firm. And more importantly, they don't cover the inevitable losses from all the other failed startups in their portfolio.
Think about this number for a second. VCs can lose money on 70% of their deals. 70%. That kind of model only works if the few winners that are left are so massive that they pay for everything else and then some.
Okay, so what's the big takeaway here? What's the crucial point for anyone out there who's looking to raise venture capital for their own idea?
The big thing to get is that this relentless hunt for a world-changing idea, it isn't just some personal preference or a cool slogan they like to use. It's a fundamental business necessity, and it's driven by that high, unavoidable cost of investment overhead.
So the next time you walk into that pitch, you have to remember their reality. They aren't just looking for a solid business. They literally need a home run that can make their entire fund a massive success. The only question left is, what story are you going to tell them?